Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, July 8th. The US revealed the tariff rates for some countries that didn't look much better than the initial race, but investors are filled with joy on the idea that the July 9th deadline is pushed back to August 1st. So the mismatch between the trade headlines and the price action in the markets becomes increasingly alarming. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So we are pretty much back to square one in terms of US tariff disaster as the US started sending letters to countries revealing their tariff rates, and the rates don't look much different than the ones that were announced on the so-called Liberation Day on April 2nd. So in numbers, it's 25% for South Korea and Japan, while note that the tariff rate for Japan was 24% in the first edition of the tariffs back in April. Trump apparently didn't get over the Japanese unwillingness to buy their rice. Then it's 25% for Malaysia, 30% for South Africa, 40% for Myanmar and Laos. So there are no fresh news regarding India and Taiwan, but the levies that we see today on some Asian nations like Vietnam, for example, are clearly pointing their finger at China for the transshipment. So there could be some disappointment and some tensions with China again. And looking further at the first wave of the numbers, there's only one country that actually pulled itself out of this tariff tantrum with minimum damage, and it is the United Kingdom with a tariff rate of 10%. And there are rumors on the wire that the European Union could also pull off a 10% tariff rate within this week, which would be great. But for the rest, the tariffs are not looking good. And the last 3-month risk rally is, in my opinion, in jeopardy, even though the market is still on a surprising wave of optimism that defies all odds and all of the renewed trade tensions and the idea that the Asian tariffs will put pressure on the supply chains and on prices. So the S&P 500 retreated 0.70% yesterday from an all-time high level, but futures are in the positive this morning on news that the new tariff negotiation deadline is kicked back to August 1st. And the Japanese Nikkei was down yesterday, but the index is up again this morning in Japan on hope that the trade negotiations between Japan and the US will continue and the 25% levies for the Japanese exports toward the US could be reversed. And the Stoxx 600 was in the positive yesterday, and the futures are in the positive as well on hope that the Europeans will finally pull out a good deal. So that's good news for them, but this is still too much unexplained optimism out there overall, because the fact that the tariff deadline is pushed back to August 1st, to me is bad news per se, because it's more uncertainty on the wire, and it is just another proof that that deadline will not be a line in the sand either, and that the tariffs that will be set within the next days and within the next weeks will not be on stone either. They will be constantly changed. They will be pulled higher, lower, and they will continue to serve as a go-to threat of Trump administration each time they are not happy. And well, the man and his administration is not often happy, meaning that these uncertainties will simply persist. So it's probably time to price back in at least some of the trade risks that have been priced out just too rapidly after the April dip under the name of taco trade, because Trump isn't necessarily chickening out and inflation is actually knocking on the door, because one of the reasons why the tariff-led price pressures were contained over the first months of the tariff chaos is because many money companies out there actually decided to wait and see and swallow the pill until the dust settles, hoping that the tariffs were just a negotiation tactic and that they would not be forever, and that, well, they would just be changed at least to something like 10%. But if the tariffs are not going away and they're much higher than the 10%, and they are also changed constantly, well, businesses will have no choice but to adopt, which means raising their prices. So according to Goldman Sachs, companies are set to pass on 70% of the tariff costs through higher price tags onto the customers. So will happen one of the following scenarios probably. One, the US consumers will eat the tariffs, and companies, so the foreign companies, will continue to export toward the United States. The earnings will remain intact, but in the US, the Federal Reserve will be upset with the rising inflation, and the rate cut expectations for the US economy will necessarily be pushed back in time or even be reversed due to higher inflation into the year end, and the latter could actually upset global investors at relatively high valuations, especially for the US stocks. Or the consumer spending in the US will crumble, the US GDP will slow, inflation will be rising, but hopefully a part of that rise in inflation that will be led by tariffs will be tempered by lower demand, and the company earnings will get a hit, but the Fed could be in a place to help if price pressures remain bearable in the US. But the reality will probably be somewhere in between these two scenarios. The prices in the US will probably rise. Earnings in the US will probably be pressured by lower consumer spending. The Fed will probably wait and see as US growth will slow, but inflation remains uncertain, and rising inflation expectations will not allow the Fed to act quickly, while global investors will be increasingly cutting their exposure to US assets, repatriate their funds to alternative markets like the EU and Japan, for example, and a possible Japanese repatriation could further weigh on the US Treasury yields and amplify a potential risk sell-off. This is what I think could realistically happen when I look at the hectic and unideal trade headlines of the moment. And note that, diving into the Japanese yields, rising Japanese yields look also increasingly threatening to the risk rally of the moment, because Japanese 10-year yield is back to 1.5% this morning. And remember, when JGB yields rise, they become more attractive to Japanese investors, especially the big Japanese institutions like pension funds and Japanese insurers, who have historically been major buyers of US treasuries and global equities, including the US stocks. So if the Japanese JGBs offer better returns, capital may flow back into the Japanese assets, reducing demand for US assets, including treasuries and equities like the S&P 500. And the heated trade tensions and the US debt worries could actually accelerate a potential repatriation of the funds back into Japan, even though the Japanese had earlier this year said that they would not pull their money back as part of trade negotiation tactic. But hey, things could change too fast right now to rely on what has been said a few months ago. If the Japanese are not happy, they can do whatever they want, right? Then the FX markets, the US dollar rebounded yesterday and is consolidating gains this morning on the back of that fragile optimism of seeing the trade deadline pushed back to August 1st from July 9th. But if you think that the August 1st deadline will be just one deadline in a series of tens of deadlines that will come to play in Donald Trump's trade book in the coming months and years, buying US dollars on trade optimism is probably a meager reason to do so. The euro dollar remains bid below the 117 mark, and the Aussie dollar bounces back quite strongly today after a surprise decision from the Reserve Bank of Australia not to cut the interest rates today as expected by analysts. The Australian policymakers, on the contrary, cited the strength of the jobs market in Australia and a more balanced inflation outlook to keep their interest rate unchanged at today's monetary policy meeting, and that is helping the Aussie recover losses today, along with some optimism that is not necessarily funded, but optimism still. In the energy and metals markets, the US crude rallied to 200-day moving average yesterday, but sees resistance near this level as both a bigger than expected OPEC output hike and renewed trade tensions are negative for oil outlook, while copper futures on COMEX retreat from the highest level since April 2nd, and that's the only place where the price action makes sense to me and matches somehow the headlines that we have. So in summary, the markets continue to react in a very suspicious and unusual way to the news, ignoring the risks and implications of the tariffs on supply chains, earnings, growth, and inflation, and assuming that everything will be magically resolved in the next 3 weeks is like seeing unicorns in the sky. So I think something must give, but I can't tell you when. So this is all for today. I am İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.